The Federal Reserve wants to shrink its $4.5 trillion balance sheet, and that may force interest rates to rise faster than you think. The Fed's balance sheet grew from about $1 trillion before the 2008 financial crisis to about $4.5 trillion currently. The balance sheet grew as the Fed bought a massive amount of Treasury and mortgage bonds to keep rates low and to boost the economy. After the Fed ended those stimulus programs, it replaced those bonds as they matured by buying more. That's the policy it wants to end now. In its most recent meeting minutes, the Fed did not disclose how it plans to reduce the balance or by how much. The balance sheet reduction is happening sooner than some expected, and it could drive higher rates for mortgages and other loans. The bottom line, reducing the Fed's massive balance sheet could lead to higher rates sooner than some expected.
The Federal Reserve raises interest rates by 1/4 point to a new target range of 1 to 1.25%. The Fed still believes gradual increases in rates will be warranted. Neil Kashkari, Minneapolis Fed president, dissented. The Fed also announced detailed plans for how it will unwind the balance sheet. The Fed says the balance sheet will begin to be unwound this year, provided the economy evolves as expected. 12 of 16 members see 3 rate hikes this year, as in 1 more additional this year. 12 of 16 members see 3 rate hikes next year in 2018. The stance of monetary policy, according to the Fed, even after today's rate hike, remains accommodative.